Artificial intelligence may change the world. But before it changes the world, it is changing the stock market. Capital is not waiting for proof. It is pricing in inevitability. Companies with even minor AI exposure are being revalued. Earnings calls now revolve around AI integration. Startups with AI in their pitch decks attract funding instantly. Infrastructure spending is accelerating. Cloud capacity is expanding. Semiconductor demand is surging. Markets are treating AI not as a technology cycle, but as a foundational economic shift. And that is where bubbles often begin. A bubble does not start with fraud. It starts with belief. A powerful idea. A legitimate innovation. A real productivity promise. Then capital flows in. Early gains validate optimism. More capital follows. Valuations rise faster than revenue. Narratives become self-reinforcing. Momentum replaces skepticism. This pattern has appeared before. The internet boom. Housing derivatives. Electric vehicle speculation. Each began with real technological or financial change. Each ended with overextension. The question is not whether AI is transformative. The question is whether capital is pricing it correctly. Markets are forward-looking. But when expectations run too far ahead of monetization, fragility increases. AI may reshape productivity. But if valuation expansion exceeds earnings capacity, the adjustment can be violent. The danger is not AI failure. It is expectation overshoot. Because when capital concentration becomes extreme, even small disappointments can trigger repricing. And in an environment of higher interest rates and tightening liquidity, repricing can accelerate quickly. The AI investment boom may be justified. Or it may be the early stages of a capital misallocation cycle. To understand the risk, we must examine how the capital flood began. Why capital flooded into AI? Investment waves begin with narrative clarity. AI provides that clarity. It promises cost reduction, margin expansion, productivity growth, market dominance. For public companies, this is powerful. If AI reduces operating expenses, margins increase. Higher margins justify higher valuations. If AI increases product differentiation, revenue growth accelerates. Revenue growth justifies premium multiples. Investors are not simply buying technology. They are buying future cash flow expectations. The first phase of capital flooding began with infrastructure. Semiconductors capable of training large models. Cloud providers expanding compute capacity. Data center investment accelerating. These are tangible revenue sources. Hardware demand surged. Infrastructure spending validated early optimism. Then came enterprise integration. Software firms embedding AI features. Productivity tools rebranding around automation. Corporate clients allocating budgets to AI transformation initiatives. The narrative expanded from infrastructure to application. When narrative expands, capital allocation broadens. Venture capital followed. Startups building AI-powered services attracted funding rounds quickly. Valuations rose even before revenue models were proven. This is typical in early innovation cycles. Capital moves ahead of certainty. Early winners produce extraordinary returns. Those returns attract new entrants. New entrants increase competition. Competition reduces pricing power. But during the early stage, competition is overshadowed by growth optimism. Public markets amplified the effect. As leading AI-related companies reported strong growth, their stock prices appreciated rapidly. Index weighting increased. Passive funds allocated more capital automatically. Momentum strategies reinforced exposure. Concentration intensified. When large-cap firms dominate index gains, capital flows into them mechanically. This creates a self-reinforcing loop. Price appreciation increases index weight. Higher index weight increases passive inflows. Higher inflows push price higher. At the same time, media coverage expands. Financial headlines emphasize AI breakthroughs. Retail investors enter. Social sentiment amplifies. The narrative becomes cultural. This cultural adoption strengthens investment conviction. But here is the structural risk. Capital allocation during rapid narrative expansion often assumes linear growth. Revenue projections extrapolate early momentum. Cost savings projections assume smooth integration. Market share projections assume limited competitive pressure. These assumptions may hold temporarily. But innovation cycles rarely remain linear. Competition intensifies. Pricing pressure emerges. Integration complexity slows adoption. Regulatory scrutiny increases. Another critical factor is time horizon compression. When investors believe a transformative technology is underway, they shorten their patience. Valuations are built on near-term dominance rather than gradual monetization. This compresses risk tolerance. If quarterly growth slows even slightly, price volatility increases. The flood of capital into AI is rational. AI has legitimate productivity potential. But rational capital can still create irrational pricing. Because pricing depends not just on growth, but on how much growth is already embedded in valuation. When capital floods into one sector aggressively, other sectors may experience relative underinvestment. Market diversification declines. Correlation risk increases. If AI becomes the dominant performance driver for major indices, macro sensitivity increases. A slowdown in AI sentiment can affect broader markets disproportionately. This is how concentration transforms innovation into systemic risk. The first phase of the AI investment cycle is enthusiasm. The second phase is valuation expansion. The third phase, if it occurs, is reality testing. We are currently between the first and second phase. Capital has flooded. Valuations have expanded. The question now is whether earnings growth can sustain those valuations in a higher rate environment. And that is where the structural tension intensifies. Valuation expansion versus revenue reality. Every investment cycle eventually confronts arithmetic. Narratives attract capital. Capital pushes prices higher. But prices must ultimately connect to earnings. Valuation is not simply about growth. It is about how much growth is already priced in. When AI enthusiasm accelerated, multiples expanded rapidly. Price-to-earnings ratios rose. Price-to-sales ratios widened. Forward projections became more optimistic. Analysts revised targets upward. The justification was straightforward. AI would unlock productivity gains. Productivity gains would increase margins. Higher margins would support sustained earnings growth. Sustained earnings growth would justify premium valuations. But there are two structural questions embedded in that logic. First, how quickly can AI-driven productivity convert into realized revenue? Second, how much of that productivity gain is already priced into current valuations? Revenue growth from AI integration is not immediate. Enterprise adoption cycles are complex. Large firms must evaluate infrastructure needs, integrate new software systems, train employees, adjust workflows. These processes take quarters, sometimes years. Meanwhile, capital markets may price in accelerated growth within months. This creates a timing mismatch. Markets discount the future rapidly. But operational transformation moves gradually. If earnings growth does not accelerate at the pace expected, valuation pressure builds. Another structural tension lies in cost dynamics. While AI promises efficiency, implementation costs are significant. Compute infrastructure, data storage expansion, security frameworks, regulatory compliance, skilled talent acquisition. These are expensive. If companies overestimate near-term cost savings, margin expansion may lag projections. This does not imply AI fails. It implies monetization may be slower than optimism assumes. Consider also competitive dynamics. When multiple firms integrate similar AI capabilities, differentiation narrows. If AI becomes standardized infrastructure, pricing power weakens. Firms may adopt AI to maintain competitiveness rather than expand profit. In that scenario, AI shifts from margin enhancer to cost of doing business. When innovation becomes commoditized, valuation premiums compress. There is also saturation risk. Initial adoption phases often show rapid growth. Early adopters integrate aggressively. Revenue spikes. But once penetration reaches a threshold, incremental growth slows. If valuations assume sustained exponential adoption, even modest deceleration can trigger repricing. Now consider market concentration. If a handful of firms dominate AI infrastructure and application layers, index exposure intensifies. When valuations of these firms expand rapidly, they disproportionately influence broader market indices. This creates structural vulnerability. If earnings disappoint even slightly, broad market impact may be amplified. Another layer of complexity is macro environment. In a low interest rate world, future earnings are discounted lightly. In a higher rate environment, future earnings are discounted more heavily. If AI valuations depend heavily on long-term projected cash flows, higher discount rates reduce present value. This makes high multiple companies more sensitive to rate volatility. The combination of elevated expectations and tighter financial conditions increases fragility. Markets do not collapse because innovation is false. They correct when expectations exceed realizable growth. A bubble does not require fraud. It requires overconfidence. And overconfidence often emerges when early success reinforces belief in inevitability. AI has demonstrated genuine capability. But capability must convert into durable, scalable revenue. If enterprise budgets tighten. If macro demand slows. If integration complexity delays productivity gains. Revenue trajectories may fall short of elevated projections. Valuations then adjust. And when valuations adjust in concentrated sectors, capital outflows can be swift. The structural issue is not whether AI companies will grow. It is whether they will grow fast enough to justify current pricing under tightening liquidity conditions. This is where arithmetic replaces narrative. When expectations are high, tolerance for disappointment is low. And in markets heavily concentrated around a single theme, disappointment can cascade. We now move to the next structural layer. Because valuation risk does not exist in isolation. It interacts with liquidity, leverage, and monetary policy. And that is where bubble mechanics accelerate. Liquidity, leverage, and the acceleration risk. Bubbles do not expand in isolation. They expand in environments that allow them to. The most powerful accelerant in any asset cycle is liquidity. Liquidity determines how easily capital can enter and exit markets. When liquidity is abundant, risk tolerance rises. When liquidity tightens, fragility is exposed. The AI investment surge began during a period of enormous monetary expansion. Global central banks had injected liquidity into financial systems following pandemic disruptions. Interest rates were near historic lows. Capital was inexpensive. Discount rates were compressed. Future earnings were valued generously. In such an environment, growth narratives flourish. When the cost of capital is low, long-duration assets, especially technology firms dependent on future cash flows, attract aggressive pricing. Now the environment is different. Interest rates are higher. Monetary policy is restrictive relative to previous years. Liquidity is more selective. This shift changes the mechanics of risk. Higher interest rates increase the cost of leverage. Margin borrowing becomes more expensive. Venture capital becomes more disciplined. Corporate borrowing costs rise. The valuation of long-term earnings becomes more sensitive to discount rates. When rates rise, the present value of distant cash flows falls. AI firms often trade on projected long-term dominance. That makes them sensitive to rate volatility. Now introduce leverage into the equation. Leverage amplifies both gains and losses. If hedge funds increase exposure to AI equities through margin, price movements accelerate. If retail investors concentrate portfolios in AI leaders, sentiment sensitivity rises. If corporate buybacks are financed with debt, capital structure risk increases. When leverage meets concentration, volatility intensifies. Another structural factor is passive investment flows. Index funds allocate capital based on market capitalization. If AI-linked firms rise in value, their index weight increases. This draws more passive capital. More passive capital pushes prices higher. But passive capital also exits mechanically during downturns. When prices fall, index weight declines. Passive funds reduce exposure. This accelerates drawdowns. The structure becomes reflexive. Price drives flow. Flow drives price. During expansion, this dynamic reinforces optimism. During contraction, it reinforces panic. Now consider credit markets. If equity valuations correct sharply, corporate financing conditions tighten. Companies that relied on high stock prices to raise capital face constraints. If those companies have invested aggressively in AI infrastructure, their balance sheets may be stressed. Reduced financing capacity slows expansion. Slower expansion reduces earnings momentum. Reduced earnings momentum pressures valuations further. The cycle feeds itself. There is also a macro overlay. If economic growth slows due to tightening monetary policy, enterprise budgets may contract. AI projects, while strategic, still require capital allocation. If corporate CFOs face revenue uncertainty, discretionary tech spending may be delayed. Delayed spending slows revenue realization for AI vendors. If revenue growth slows while valuations remain elevated, repricing risk increases. Liquidity conditions determine how smoothly adjustments occur. In deep liquidity environments, corrections are absorbed gradually. In thin liquidity environments, corrections can be abrupt. Current conditions are not crisis-level restrictive. But they are tighter than the period that launched the AI surge. This means capital must now justify itself more carefully. When liquidity is abundant, capital chases narrative. When liquidity tightens, capital demands proof. This transition phase is delicate. If earnings reports confirm optimistic projections, valuations stabilize. If earnings lag, repricing accelerates. Liquidity does not need to disappear to cause volatility. It only needs to tighten enough to reduce marginal buyer enthusiasm. Markets are often driven at the margin. The marginal buyer determines price. If the marginal buyer becomes cautious, price momentum slows. If price momentum slows, sentiment shifts. If sentiment shifts in a concentrated sector, volatility spreads. The AI investment narrative is strong. But narrative strength does not eliminate liquidity risk. It interacts with it. And when narrative, valuation, leverage, and liquidity converge, bubbles form not because innovation fails, but because capital moves faster than fundamentals. The question now is not whether AI is transformative. It is what happens if expectations decelerate. And what that deceleration would mean for a market increasingly dependent on AI optimism. What happens if the AI investment cycle unwinds? Bubbles rarely collapse because innovation disappears. They unwind because expectations reset. If the AI investment cycle slows, the most immediate effect would not be technological regression. It would be valuation compression. When growth expectations moderate, multiples contract. Even if revenue continues rising, slower than expected growth can trigger repricing. High multiple sectors are especially sensitive to this. If leading AI firms miss earnings projections or guide cautiously, investor sentiment can shift quickly. In concentrated markets, repricing in dominant firms affects index performance broadly. A moderate correction can become amplified. The first impact is financial. Equity markets decline. Wealth effects weaken. High net worth households may reduce discretionary spending. Corporate confidence softens. But the second impact is structural. If AI firms have invested heavily in infrastructure based on aggressive growth assumptions, slower revenue realization strains balance sheets. Hiring slows. Expansion plans pause. Capital expenditures are reassessed. The labor displacement cycle from automation may intersect with a hiring slowdown in the AI sector itself. This compounds employment uncertainty. Another layer involves venture capital. If public market valuations compress, late-stage startup funding tightens. Valuations of private AI firms adjust downward. Funding rounds become more selective. Some startups fail. Talent supply increases as smaller firms struggle. This creates volatility within the innovation ecosystem. The broader risk lies in confidence. Financial systems are highly interconnected. If AI-linked equities have driven recent index gains, and those gains reverse, broader market sentiment can deteriorate. Reduced equity valuations tighten financial conditions indirectly. Lower valuations make capital raising harder. Harder capital raising reduces investment appetite. Reduced investment dampens growth expectations. This is how a sector-specific repricing can influence macro conditions. Now consider household exposure. Retail investors have increasingly participated in thematic technology investments. If sentiment shifts sharply, retail losses may affect spending confidence. Even if macro fundamentals remain stable, perception of instability affects behavior. Economic slowdowns often begin with confidence shifts. There is also geopolitical exposure. Nations competing for AI leadership have tied industrial policy to technological dominance. If the investment cycle cools, political pressure may increase to sustain momentum through subsidies or fiscal support. Fiscal support increases public spending. Public spending increases deficits. Deficits increase debt. We return to the debt sustainability question. If markets simultaneously experience valuation compression and fiscal strain, volatility compounds. But an unwinding does not necessarily mean collapse. It can mean normalization. Valuations compress to align with sustainable growth. Speculative excess is removed. Capital reallocates more efficiently. Innovation continues at a steadier pace. The key difference between correction and crisis lies in leverage and concentration. If leverage is moderate and concentration manageable, the adjustment can be orderly. If leverage is elevated and exposure highly concentrated, the adjustment may accelerate. The structural risk is not AI failure. It is synchronized adjustment across labor, capital, and liquidity channels. If automation suppresses wage growth while AI valuations compress and liquidity remains tight, multiple pressures converge. When multiple pressures converge, economic resilience is tested. This is why the AI investment cycle matters beyond stock prices. It influences capital allocation, labor markets, fiscal planning, consumer confidence, monetary policy, innovation strategy. The bubble question is not binary. AI is transformative. But transformative technologies often pass through speculative phases. The danger lies in excess expectation, not innovation itself. If expectations remain aligned with realizable growth, the cycle stabilizes. If expectations overshoot and liquidity tightens, repricing becomes sharper. The economy can absorb technological change. But it struggles when capital, labor, and confidence adjust simultaneously. That is the real risk beneath the AI investment boom. Artificial intelligence is not a fraud. It is not a passing trend. It is a transformative technology with real productivity potential. The risk does not lie in the technology itself. It lies in expectation. Markets price the future. But when the future is priced too aggressively, even small deviations can trigger volatility. AI may reshape industries. It may redefine labor markets. It may increase productivity across sectors. But productivity does not automatically justify any valuation. Capital cycles often begin with clarity and end with complexity. Early success reinforces belief. Belief attracts capital. Capital inflates pricing. Pricing amplifies narrative. Eventually, narrative must reconcile with arithmetic. If earnings growth sustains valuation expansion, the cycle stabilizes. If earnings growth lags expectation, repricing begins. Repricing is not collapse. It is correction. But in a market environment shaped by higher interest rates and tighter liquidity, corrections can move quickly. The AI investment boom connects to broader structural forces. Labor displacement. Debt sustainability. Monetary policy. Capital concentration. Each layer increases sensitivity. Innovation can strengthen economies. But innovation combined with mispricing can destabilize them. The difference lies in balance. Balance between productivity and purchasing power. Balance between growth and valuation. Balance between liquidity and leverage. Balance between optimism and discipline. The AI investment cycle may normalize gradually, or it may reset sharply. Either path depends not on whether AI is powerful, but on how expectations adjust. In the next episode, we escalate further. Because if you thought the AI investment bubble was risky, the next layer reveals how speculative concentration interacts